Good afternoon, everybody. Welcome to the session. My name is Joe Fitzgerald from MoneyShow. I will be your host. And two quick bits of housekeeping. I'm going to hand the floor right off to Peter. First and foremost, we appreciate everybody who attends these sessions. Of course, we appreciate folks like Peter on the leading edge of thought giving us their insights. But everybody continue to give us your feedback, comments, and suggestions here at MoneyShow. We appreciate it, and it makes us better. Secondly, there'll be some questions and answers at the end of this session, time permitting. So there is a chat box on your desktop. Shoot those questions over during Peter's session, and we'll try to get to as many as we possibly can at the end of his session, which is lasting about 30 minutes. With that said, it's my great pleasure to introduce to everybody Peter KRAUTH, who is a former portfolio advisor and 20-year veteran of the resource market with special expertise in precious metals, mining, and energy stocks. Peter is the editor of two newsletters to help investors profit from metal market opportunities. Those are the Silver Stock Investor and the Gold Resource Investor. In those letters, Peter writes about what he is buying and selling, and he takes no pay from companies for his coverage. With that said, it is my great pleasure to introduce to you Peter KRAUTH. Peter, the floor is yours, sir.
Well, thanks very much, Joe. I certainly appreciate that. And I'd like to thank everyone for attending today. And I'd like to thank MoneyShow for hosting these fantastic events. So my presentation today will be on silver and how you can profit from the coming silver shock. So let's get right to it. Today's topics, I'm going to split it into four sections. The first is about silver demand drivers, being inflation and industrial demand. Then we'll move on to silver and how and why it's the cheapest asset. Next will be the coming silver shock and what you can expect in terms of silver and silver prices going forward. And finally, how to invest in silver. Silver demand drivers. So first of all, silver is very unique in the sense that it's both a monetary and an industrial metal. No other metal can really say that to the same extent. And so it's actually being driven very much right now by both of those characteristics. The first being inflation. And as we all know, we've seen tremendous inflation over the past sort of year and a half. The consumer price index is rising at about 5.4%. We've seen that over the last 12 months. July's number was 0.5% for the month, 0.9% for June, which was the largest 1 month change since 2008. So that's in the last 13 years. And, as much as the Fed wants us to believe that it's a transitory thing, I certainly don't believe that. Even if they turn out to be right, something to keep in mind is that although inflation, let's say it were to flatten, or even if it were to go on at zero, which nobody expects over the next little while, all the increases we've had so far are baked in increases. And all of these increases have pushed prices up in a permanent way. And if we look even at things like the food, energy, gasoline indexes that are not in the consumer price index because of their volatility, they're even higher than the monthly numbers. So food at 0.7% for July, food away from home, 0.8%, energy at 1.6%, and gasoline at 2.4%. So certainly we see a lot of strength on the inflation side. Silver is being driven, like I said, by the ideal conditions right now. Both demand drivers are as an inflation hedge and from the industrial demand side. The chart on the left is inflation expectations looking forward 5 years. And what we can see is that after it basically cratered in March of last year, it's actually been soaring and has taken out previous highs of the last 4 years. And inflation expectations certainly consumer price index, we can certainly see that consumer prices have been accelerating in the last several months, in fact. So they've been rising steadily. They dipped in late March through the summer of last year, picked up, returned to the same growth curve, and then in the last sort of 5 to 6 months have actually, as I say, accelerated higher. Commodities are breaking out. It's interesting to see a parallel. The previous chart of the 5-year forward inflation expectation is plotted together with commodities prices, and we know that they rise in lockstep. So the dark blue line on the left is inflation expectations. So again, from that previous chart, and if we see how commodities prices have been tracking inflation expectations, well, it's, as I say, very much in lockstep. Makes sense. If producers, anyone consuming these commodities, expect prices to go up, then they start to raise their prices. The chart on the right is the producer price index. So that naturally will reflect things like raw materials that go into manufacturing. And we can see a very clear, very dramatic breakout in the last sort of 9 to 12 months, all the way over on the right side of that chart. And so, of course, all these inputs, these commodities and raw material inputs would, of course, affect producer prices. Commodities are still cheap, and many sophisticated analysts believe that we're entering a new commodities bull market. If we look at the last 50 years or so, and we relate commodities prices to the S&P 500 index, actually recently they dipped to a point that is the lowest that they've been in 50 years. And so in terms of value, commodities are still extremely cheap. And if just for them to get back to an average of the last 50 years, it'd need to be up probably more than about 4 times from their current level. Looking more recently at the CRB Commodities Index, we can see that it has clearly in the last few months broken out from about 6-year range. And again, just sort of more confirmation that we're in a new commodities bull market. So what's driving all of this? Well, in part, at least, a green global revolution. If we look back over the last few centuries, the first industrial revolution was in the 1700s, all about the steam engine and mechanization driven by burning coal. The second industrial revolution was all about mass production and assembly lines in the 1800s, again, fueled by coal, which produced electricity. The third revolution was all about automation and computing in the previous century. And that was driven by, again, fossil fuels, a variety of fuels, and nuclear energy. And the current industrial revolution, being the fourth one, is all about networks, interconnectivity. There's a clear transition to clean energy. And the interesting thing about this particular revolution is that it's a globally coordinated and a strategic effort we see on the economic and social side. So clean energy is a big demand factor for silver, and certainly will help support silver demand going forward. Silver supply, however, is seriously challenged. If we look at mine supply, it actually peaked in 2015. It has been declining steadily for the last 5 years. It absolutely clearly got worse last year because of shutdowns due to COVID. But it's an industry-wide issue. It's not a localized thing. If we look at the 10 largest silver producing countries, all of them have seen their silver production fall off in the last about 5 years or so. An interesting thing about silver is that only, or actually less than 30% of silver comes from what we call primary silver mines. So about 73% of all silver produced is not from mainly silver mines. It's actually silver produced as a byproduct of mining other metals like gold, lead, zinc, and copper. Now, the thing to keep in mind to retain about that is that makes the silver price somewhat inelastic. The producers, the majority of silver miners, view silver as a byproduct and therefore not central to their revenue stream of producing other metals. And so when the silver price rises, they're likely to be less motivated. And even if they could, it's a long and drawn out process to try and increase output from a mine. But even if they're motivated to do so because they see higher silver prices, that's balanced out by the fact that silver is a small portion of their revenues. So low supply together with growing demand is likely to lead to even higher prices on silver. We look at demand last year, and this chart, actually, this pie chart excludes demand from ETFs, which is what the main research firms will do. Industrial demand accounts for about half of silver requirements every year. Physical investment represents about 22%. And then you've got jewelry and silverware balancing things out. Photography is a small slice of the pie and declining yearly. The sort of wild card in all of this is investment demand, and that certainly has been exploding. Interestingly, last year, silver ETF holdings absolutely skyrocketed to 1.2 billion ounces if you total up all the silver ETFs worldwide. And that number, which we reached at the end of March of this year, represents more than the entire annual supply of silver, which is roughly about 1 billion ounces. Silver demand for physical silver has caused premiums to soar for coins and bars. They're currently nearly triple what normal levels are at about 40 to 45%, where they are normally for smaller coins and bars are normally closer to about 15%. And we haven't seen that back off in the past year and a half when the pandemic hit. And there have been certainly some events like the Wall Street Bets push and the silver squeeze that has brought big attention to silver. In fact, interestingly enough, it's actually drawn in a new generation, a younger generation who are participating in this market and see silver as a way to help increase their portfolio values. U.S. Mint has several times called a global silver shortage, and as they see record demand and don't expect that to drop off. Here, if we look at, this is my own chart where I include the demand from silver ETFs together with physical demand that actually practically doubles physical investment in silver from about 22% to 43%. And so this is certainly, again, as I say, I believe grossly underestimated. Again, I think the demand from investment on the investment side for silver is the wild card. And if we look at just silver ETF demand last year, which was 250 million ounces, it was actually, that actually would have caused a deficit in this net silver supply of about 25%, which is huge, just coming from a single demand driver. Silver has many industrial applications. Solar panels are the single largest demand factor for silver, representing 10% of all demand, 100 million ounces a year. And that's trending upwards as installations of silver panels continue to rise. Automobiles and the automotive sector represent about 60 million ounces or 6% annually. The Silver Institute expects that to rise to 90 million ounces. So that's a 50% rise in just the next 4 years. And by the way, EVs and hybrids, or EVs in particular, use about twice as much silver as the internal combustion engine vehicles use. Electronics are a big demand side as well. Printed and flexible electronics currently use about 48 million ounces annually, and the Institute again expects that to rise to about 74 million ounces by 2030. And silver in medicine is actually a long-running known driver. Silver has been used for centuries in medicine. It's well known to do things like kill bacteria, limit infections, and therefore we see it embedded in things like medical equipment. Silver nanoparticles are present in cornea replacements, they're in contact lenses, and we see new applications in medicine for silver come out practically on a daily basis. So silver, I call it the cheapest asset, and I'm about to explain to you exactly why that is. Currently, if we just look at the price of silver right now and make no adjustment for inflation, the peak all-time high, nominal high, was hit in 1980. It was $50. We're currently at the $24 level. So just on nominal prices, silver is still 50% below its all-time high. If we go for inflation-adjusted silver prices, so this chart shows us inflation-adjusted silver prices going back to 1970s. The peak that we see on the left in 1980, this chart shows it actually closer to about 125. That's a little bit misleading. It's only because this chart provides silver prices on a monthly basis, and intramonths silver certainly reached closer to, on an inflation adjusted basis, closer to about 165. And so that's why my arrow starts higher. And if you use inflation adjusted prices from 1980 versus today, silver, in fact, on that basis is still 85% below its all-time high. A dollar invested in silver in 1970 is worth about $16 at the end of last year. A dollar invested in gold in 1970 was worth $50 at the end of last year. So as we can see in this chart, that red oval shows you the gap where silver has a lot of room to make up to catch up to gold. And another comparison is silver versus the S&P. Back in 1980, when silver peaked, the ratio of silver to the S&P was 0.445. It's currently closer to 0.007. So silver, the S&P measured in the silver price is near all-time lows. And if you compare those two points in time, silver is currently about 98% below its 1980 peak. And one last comparison, this is a table of prices for several of the main base metals, as well as some platinum group metals and precious metals. And as it turns out, if you look at the price of silver versus these other metals, silver is still the only of these 11 metals that is still below its nominal 1980 price. Each and every one of these other metals is higher. And in fact, the lowest is about at least 70% higher than its 1980 high. So silver is still very cheap by many standards. I believe, therefore, silver has much higher to go. We've seen how on a relative basis, it's inexpensive. On a historical basis, it's inexpensive. On a fundamental basis, being supply demand, it's as well very inexpensive. On a technical basis, I also think that silver has a lot higher to go. The technical side of things shows kind of what happened in the last 2 years. Silver bottomed after dropping to $12 back in March of last year at the peak of the pandemic. It then turned around and put in a tremendous rally from $12 to $30. That was actually the equivalent of a 250% return on its price in a 5-month time frame. Since then, that's quite the gain. So since then, it's been digesting those gains, moving sideways in a range between, and this is a weekly price chart, but so between $23 and $28, it's been moving in that range. And so on a weekly basis, it has tested that $23 3 times, again, just recently. And as technical analysis goes, the more time it spends within a channel and the more times it tests a support level, the higher energy it builds up for a likely breakout going forward. Sorry, one last thing. If we look at the technical indicators of momentum, these 3 ovals here, here, and here, we see that on a momentum basis, silver seems to be potentially bottoming and have some considerable upside ahead. So how high can silver go? Well, in the 1970s, from bottom to top, 71 to 1980, silver was actually up 3,640%, so about 37 times. In the 2001 to 2011 bull market, silver was up nearly 11 times, 1,080%. Here's what silver can do, silver stocks can do versus silver. In 2016, for about the first 6 or 7 months of the year, silver started to break out. The silver price was up about 48%, and silver stocks as measured by the SIL ETF, which is a basket of silver stocks, was actually up by 240% in that same time frame. So that offered a 5 times leverage to the price of silver, again, in a very short time. Since March of last year, silver stocks have been outperforming gold stocks. They're currently up about 111%, again, using the SIL ETF as a measure, versus the GDX for gold. So that's close-ish to about a 2-to-1 outperformance. We see silver stocks now outperforming since the past year and a half. That's something I certainly expect to continue, especially as the gold to silver ratio falls and continues to fall. So my target for silver, this is what I call the coming silver shock. My target price is ultimately for silver to reach a $300 peak. And I'm going to explain exactly how and why I believe it can get to that level. Currently, as I see it, silver is entering the acceleration phase. We've seen silver start to outperform gold, especially since last year. Silver stocks are also outperforming gold. And one thing that we know is that silver always outperforms gold in bull markets. So we saw a big run up in silver in the late 70s. We saw a big run up in silver in 2011. And I believe we've started that same sort of action in the last year and a half with silver. As I say, it always outperforms gold in bull markets. So this shows percentage gains in silver versus gold in the 1980 peak. So as we can see here, silver dramatically outperformed gold on a percentage basis. In the 2011 silver versus gold peak, again, it outperformed gold. Currently, silver since last year has performed well, but is still underperforming gold. However, because of the action of the last year and a half, I believe this gap is going to start to close as well. So my estimates for an ultimate peak, if we look at the 1980 gold to silver ratio, it bottomed at 15, which we see on the chart down here. So my ultimate peak for gold, although potentially I think it could easily go even higher, is at least $5,000. If we use a 15-to-1 ratio, 15-to-1 on a $5,000 gold price gives us $330 silver. If we use the $50 peak in silver in 1980 and we compound $50 at a 5% annual rate, ever since 1980, that actually gives us a $369 silver price. And I use the inflation numbers in this chart here on the right, which I quote from Shadow Stats, which is an alternate calculation of inflation going back to 1980, and actually uses the government's own calculations, which they've changed over the years, but based on their 1980 formula. And so if you look at that, Shadow Stats has inflation currently closer to about 10%, whereas the official numbers are closer to currently about, let's say, 2.5% to 3% averaging. So I went in between. I thought that would be fair and used 5%, and that brought me to $369 silver. So the outlook for silver I consider to be exceptionally strong. We've seen, although gold and silver miners are, as a group, net debt free, over the past sort of 2 years, they've seen tremendous free cash flow. They're throwing off a lot of profits. They've certainly benefited from the previous bear market. They've gotten their balance sheets in order. As I say, they're net debt free. And cash flow is tremendous because gold and silver prices have risen considerably in the last couple of years. And they're depleting reserves. They're not replacing them. And that makes the potential for silver producers or smaller silver explorers who have deposits to be revalued considerably higher as M&A starts to pick up. The consensus forecast for silver this year is for it to potentially reach $28 to $30, which is Still certainly quite a bit higher than it is now. My view is that it could do considerably better. I think we could potentially reach closer to $35 to $37 on the upside. Again, I think that the wild card is the investment demand. If you combine that with industrial demand, both are being considerably underestimated as we speak. So how do you invest in silver and profit from it?
Peter, just a quick heads up. You have about 5 or 6 minutes, just so you know, sir.
Thanks, Joe.
You're very welcome.
So we've got multiple investment options. Physical silver, you can buy coins, you can buy bars. The issue with that right now, although I'm a proponent of that, premiums are very high. If you want some exposure, maybe buy a little, wait for premiums to come down. Physically backed silver ETFs, they're not all the same. I have a clear preference for the Sprott PSLV silver ETF. It has low premiums, better management and construction. If you look at the fine detail, it's a superior product. Next up, you have silver miner ETFs. That's a one-click way to buy a basket of silver miners. And then from there, you have royalty and streaming companies. You have large producers, growing producers, developers, and junior explorers. How do I vet silver investments? Well, my criteria are management, grade, and location as my first level of filters. Management, I certainly look for experience, depth, and prior successes. If it's a smaller exploration company, they need to have access to great knowledge resources to have better odds of finding and or expanding a deposit. Grade, certainly higher is better. If it's a company only has a resource, I look for close to or at least 50% or higher silver content on their main project. If it's a producing company, I look for close to or higher than 50% of revenues from silver production. Location is certainly important. Safer is better. I favor North America, Canada, US, Mexico, Australia, and some parts of Europe, South America. There are a few places exceptionally that I consider okay. Otherwise, the majority are typically, in my view, to be avoided. So how do you approach this? I think the best way is to be early and be right. Identify a bull market as early as possible. Silver, as I say, is still sitting 50% below its all-time nominal high. If you can do that, get invested, hold on through corrections. You can maximize your profits. Remember, silver is a very volatile metal. The stocks are as well. If you know that and you expect it, then you're less likely to get shaken out. And you can benefit from the rising tide. You don't have to pick all the absolute best silver stocks. This is going to be one bull market for the history books. And even I believe the average silver stock will do very well. So to summarize, Silver Stock Investor is a silver-focused newsletter. It's all about what I buy and sell with my money. It's unbiased research. I take no compensation from the companies that I cover. I cover the full risk spectrum from physical silver and ETFs all the way down to junior explorers. And it's really aimed at everyone from new to all the way up to more experienced investors. And I do that by covering the market in general, as well as everything from low to higher risk stocks. It's published by Resource Maven. You can check that out at resourcemaven.ca, or you can also go to silverstockinvestor.com. We're independent and supported exclusively by subscribers. We don't take any compensation from companies for coverage. And as a precious metals expert, I regularly contribute to these media outlets, as you see here. Remember, silver is in a very compelling bull market. I believe there is a big silver price shock that's coming. My target is $300. And for viewers today, we have an interesting offer. People can get 90% off, and that is just $15 for the first 3 months subscription. That's 15 Canadian dollars, so even cheaper for you US viewers. Just need to go to resourcemaven.ca/subscribe, select the $49 per month membership, and add in promo code SILVER90, and that will get you there. So that is it for me. Thank you to everyone for listening. And if there are any questions, at any time, I'm glad to take those.
Peter, a fantastic presentation, number one. Unfortunately, we're out of time now, but I will say this. You got a lot of comments in the chat room saying how great this presentation was. I think when they saw the $333 price target at silver, it kind of lit up the room. You answered a lot of the questions towards the end of the presentation, so thank you. Unfortunately, we don't, but I would, folks, tell you, I have no axe to grind here, but use Peter's newsletter as part of your investment process. I'm familiar with Peter over the years. Somebody introduced him to me a long time ago, and his insights are spot on. So I urge you to take advantage of his offer today. With that said, we want to thank everybody who participates in these virtual events. We want to thank you. Continue with your comments and your suggestions and your feedback to us here at Money Show. It makes us better. And I'll also say, we are back live in Las Vegas next month, September 12th to the 14th. It is our last face-to-face event this year. I urge you, if you're near Las Vegas or if you think you may have the itch to go to Las Vegas, come see us because we're putting the brightest and best minds in the room, truly on the leading edge of thought. So come it's important for your portfolios, obviously, as we end the year. With that said, Peter, thank you very much, sir, for your insights. We appreciate you here at Money Show. We want to wish you a rest of your good week. And folks, thank you for joining us and enjoy the rest of the sessions today. And have a good week, everybody. Thanks again, Peter.
Thank you, Joe. And again, thanks to everyone.
Have a great day, sir. Thank you all.